Welcome to Realcast, the weekly roundup of the real asset markets. Pleased to be back in London after trips to both Singapore and Paris over the last 7 days. Dan, I know you've also been to France with MAPIC, but let's pick up on your kind of key takeaways from the last 7 days.
Yeah, well, indeed. It's been quite a busy week. The news on Friday is that Canadian investor Cadillac Fairview, which is, of course, the real estate arm of the Ontario Teachers' Pensions Plan, they've acquired a 25% stake in Stanhope, the UK developer. That kind of progresses their expansion of a joint venture platform that the two partners have had. They've been building it up in the UK, and they've got several master plans in areas like White City, which is where I'm sitting today. But Cadillac Fairview joins up with Mitsui Fudosan and Aimco as shareholders in Stanhope, who between them are now going to own or control 80% of Stanhope. Elsewhere around Europe, in the residential sector, Larfa Properties have invested 77 million euros into the revitalisation of the Beato Quarter in Lisbon. And of that 77 million, it includes 50 million going into the repositioning and redevelopment of the Beato Convent building, which is in one of the areas of the city with the greatest cultural and artistic potential. That aims to rehabilitate about 5 resi buildings in the first phase and 3 more in the second phase, and so really building on that resi story that we've been following here at Realcast. Shifting over to retail, Savills released a piece on European retail and really looking at the fair pricing of assets in 2023, with the key takeaway points being that, as a surprise really to many, that retail is set to be the most resilient asset class of 2022. And who would have said that? You know, of the 26.9 billion euros invested into the retail sector so far, means that it's up 25% year on year. Of that, grocery stores are still accounting for about a third of all retail investment activity in Europe. But investment into discounted retailers has already doubled year on year. But and all of this despite the fact that prime high street rents are still down about 34% on the pre-pandemic peak. So interesting news coming out there from Savills. Then going back to MAPIC, there was a large announcement that Warner Brothers will partner with Saudi Entertainment Ventures 7, which is, of course, the wholly owned subsidiary of PIF, the Public Investment Fund in Saudi Arabia. And they're going to bring a purpose-built indoor adventure centre to the kingdom, which integrates into Discovery Media's content from right across the globe. The first Discovery Adventure Centre is going to be about 3,000 square meters and will open in Riyadh, in one of 7 entertainment destinations in the Al Hamra district. And of course, the other big piece of news that came out of MAPIC came from the Daria Gate Development Authority at Daria Square. And they signed a deal to open up Timeout Market Riyadh with a 9,000 square meter Timeout Market set to open in 2027. And that is, of course, very quickly after the Timeout Market opened up in Dubai last year. But this Timeout Market in Riyadh is going to be nearly twice the size of the Dubai development.
Interesting, the huge amount of development and activity there in Saudi, but actually across the Middle East. And the focus on retail there was also reflected actually in comments by Alex Jeffries of Savills Investment Management at the Outlook in Singapore, where he picked retail as one of the areas that was a big opportunity for 2023. So very interesting to see how that view on retail has been changing. Nicole, what have you been watching?
Well, sticking to France, Real Asset Media held a briefing, part of our Outlook 2023 series, with a focus, of course, on France, Taylor Wessing's offices in central Paris. And the agreement seemed to be that France is weathering the crisis much better than other European countries. The assets are being repriced and activity is slowing down as it's happening elsewhere, but the process will be smoother in France. Benjamin Cartier-Bresson of Berlin HIP said that the market is extremely deep and very liquid, and also there's a strong presence of domestic investors. We've always seen that account for about 65% of activity, but coupled with a strong inflow of new capital from elsewhere, from the US and from the Middle East in particular in the last few months. And Alfred Fink of Taylor Wessing said that the big funds in France are cooperating and sort of doing off-market deals rather than to avoid a big crash. So there seems to be this stress, he said, is being kept in check and not brought out into the open as it is, he said, in the UK market, for example. And that ensures a smooth transition and a more stable market. Debt funds are also having more of a presence in the French market, obviously looking for opportunities, as well as high net worth individuals that are really coming in a big way. And so basically, yes, prices are going down, but there's no distress. And another characteristic of the French market that everyone highlighted is the increasing polarization of the market, sort of bifurcation between top assets and sort of there's a definite divide between core assets in good locations, sort of top quality, ESG compliant, and the secondary assets in the outskirts. And Guillaume Turcas of Faro Capital Partners said that it's a market of winners and losers. In the Paris CBD, both retail, high-end retail and offices, rents are rising, demand is growing, and prices are increasing, while suburban malls and suburban offices are really struggling. He said if the asset is not perfect, he said the banks won't be interested and you will not find a tenant. So real polarization there. And another agreement was that Paris continues to dominate. You know, the regions have come up. There are strong CBDs in a lot of regional cities, but investors' attention, whether domestic or international, continues to focus on the capital. And as well as Paris, I also went to Milan, which was very interesting. It was Coima, the company that has basically put Milan on the international investors' map. In the last few years, has unveiled its latest project, which is Porta Romana. It's a redevelopment, regeneration of an entire area around the Porta Romana train station. And it's going to host the Olympic Village for the Winter Olympics of 2026 that Milan is hosting with Cortina. And what is really interesting is that they've really thought ahead. So the Olympic Village, within weeks of the Olympics ending, will become purpose-built student housing. So it's been built ESG compliant, very green, which has been a characteristic of all Coima buildings, but already will serve the community within weeks of the Olympics ending.
Paul, what have you been watching?
Well, there's been a few interesting stories I've noted on the living side of the market. Retailer John Lewis and Aberdeen have formed a joint venture. They're planning to create 1,000 new build-to-rent homes in 3 UK projects, all located in London and the South East. And the schemes will have a total gross development value of about £500 million. The deal will bring together Aberdeen's investment management experience. It's got 30,000 residential units under management, and John Lewis Partnerships brand and reputation for service. The homes will actually be furnished by John Lewis. The duo said that the new venture creates a unique platform for the UK's build-to-rent market, which is largely confined to real estate companies at the moment. Then Patrizia has been making moves in the Dutch build-to-rent market using sustainable timber, and it's completed a €40 million build-to-rent neighbourhood, one of the first in a new generation that uses cross-laminated timber, which is produced by gluing layers of trimmed kiln-dried timber. It's a development of 40 single-family homes and 7 urban villas in Amersfoort, near Amsterdam. The really interesting thing is that the project also includes 63 apartments constructed of conventional materials, which provides a benchmark to assess the performance of the two construction types. Then we see that AXA IM made its first investment in the Japanese care home market with a €156 million portfolio acquisition. The deal is AXA's 4th acquisition in Japan this year and increases its assets under management there to about €3.5 billion equivalent. Continuing on the care home theme, Knight Frank's 2022 UK care homes trading performance review states that occupancy levels are improving towards a normalized state. So some homes are already trading at pre-pandemic levels, and occupancy rates across the UK are up to 84.3% compared to 79% in 2021. So the growing demand for beds has increased average weekly fees by 3.3% year on year. However, Julian Evans, head of healthcare there, says that it would be remiss not to acknowledge the potential headwinds due to inflationary pressures with rising energy costs, cost of living crisis, staffing shortages, and the extent that average weekly fees can increase in line with these costs.
Yeah, it was interesting. I saw research from Colliers predicting a big reset as real estate markets stabilize by mid-2023, and there seems to be a kind of consensus around that as well. Also noticed that there was a joint venture between Kegel and Premier for solar and wind power in Spain, and that new energy piece is something that we're going to be focusing on with a special online briefing this week, looking particularly at investing in new energy. Thanks, Paul. Thank you, Nicole. Thank you, Dan. Thank you for joining us, and look forward to seeing you next week for our regular roundup of the real asset markets.